Good morning, everyone. This is Aaron Oakes. I'm the Managing Consultant here at JRG Advisors. I want to welcome all our clients and all our association members to this webinar. This is something that we do usually on a monthly basis, but for the last 2 weeks, this is a part 2 of a 2-week program that we put together. This part we will be talking about self-funded health insurance. Just a little housekeeping, you will get a copy of the webinar replay of this presentation. You also get a copy of the PowerPoint that goes along with it, and you will get a copy of the questions and answers that will take place at the end of this presentation. If you do have a question, what I recommend that you do is type it in the question box. I think it's on the right-hand side of your screen, and then you definitely want to hit send. A lot of people just type in there and then forget to hit send, but hit send. We will go through all those questions and we will provide live answers at the end of the presentation. And if I don't know the answer to your question, we will certainly get back to you and then share all that information on our Q&A that will go out to all the participants here today. So thank you very much for attending. Today's objectives, it is all about self-insured, but the first thing we want to do is go through today's objectives and agendas, and part of that is we're going to provide the basis to understand the difference between fully insured and what's called self-funded, self-insured, sometimes called ASO or Administrative Services Only health insurance, and so we'll go through all that. We'll explain the differentiating elements of self-insured health insurance plans. We'll review the potential advantages with self-funded health insurance, and we'll also provide the basic information that you need to pre-qualify if you are interested in taking action and looking to see if self-funded is an option. So first, let's talk about fully insured plans. A lot of times people, they know they're in a fully insured plan, but they don't really know what that means. The plan sponsor is always the employer, and in this case, in a fully insured arrangement, that employer would pay a fixed premium to an insurance company. So those are the rates. Those are the rates that you pay. That's obviously called the premium. The insurance company pays the health care claims as well as the risk charge, taxes, and administrative costs. And so to process those claims costs money. They also build in risk, which is called a risk charge. They'll build in risk depending on your size and other demographics and historical claims of your company. And then they'll build in taxes and then other admin costs, whether it be wellness, all that kind of stuff is already built into, I'll use Highmark as an example. Highmark would build in all those other costs as a fixed cost to themselves and then pass it on to you in the form of part of that rate. So that's what you're paying for in a fully insured arrangement. If your actual health care claims are higher than expected, then the insurance company you would cover it. And that's why you have insurance, because you can't really predict always what you're going to do year to year. And so the insurance company covers all that risk and cost that comes with it. If the claims are lower than expected, of course the insurance company keeps the difference. That's their profit. And usually an insurance company would want to have a medical loss ratio, as it's called, which is just the amount of claims that they bring in compared to their overall premium that they bring in. They want to be in around the 89%, or meaning they have a 10 or 11% to play with, and that's in the form of, that would be profitable to them. If you're higher than that, that's when things get ugly with your rates the next year. Most insurance companies will not provide any claims data to your employers with less than 100 insured, and so a lot of, obviously a lot of JRG's clients are less than 100, and I often get asked, why can't I get my claims? Why can't I get my claims? One of the reasons is it's just a lot for insurance companies to do that. Second of all, they will claim that if you're under 100 employees, then it's easier to identify people by their claims and possibly discriminate and share PHI if it shouldn't be done. But in general, you know, they just won't do it. Insurance companies won't do it. If you get above 100 employees, that's when you can start getting utilization reports that are generic and aggregate on a fully insured account, but still more helpful than not getting any at all. So the cost of fully insured versus self-funded. So on the fully insured side, obviously I just went over this. You have the orange or red column, and that is non-refundable premium. So you give them your money and you don't get anything back. On a self-funded plan, you have, let's start from the bottom. So you have 3 parts to the self-funded plan, and I'll go into this in more detail. You have administrative expenses. You have something called stop-loss premiums, which is just reinsurance on top of your policy so that it protects you against catastrophic risk. And then you have your actual claims, which in theory you are paying out of your own pocket. Okay? And then you have potential savings if all those 3 add up to less than what you were paying before in a fully insured rate. So there is potential savings there, and you can see that just in that column. The yellow part represents that. And then we'll talk about that more, but let's talk about responsibilities of insurance companies versus employers. So in a fully insured plan, obviously the insurance company has all the risk. They take care of state regulations, and the premium comes into them, and they take care of all those things for that premium. That's the funding part. On a self-funded plan, the employer holds the risk because, in fact, you are at that point, you can think of yourself as the insurance company at that point. So if you're a group of 60 employees, and you are self-funded, you are, in fact, an insurance company and are responsible to pay all those claims. Okay. You are also responsible for a little more compliance in ERISA. And by the way, employers are also responsible on ERISA on the other side, on fully insured. But if you go self-funded, there's a couple other things that you have to be compliant related to ERISA, and our compliance department would obviously work with you on that. And then on the funding side, you're not paying a premium so much. You're not really doing anything but paying a third-party administrator, and that's how that would work. I'll go through that in a minute. But a third-party administrator actually processes your claims, and you pay them an admin amount to do that. Okay. So let's talk, like I said, more about the structure of self-funded insurance. And again, you have 3 parts. You have administration, you have third-party administrator, and you have expecting claims. Okay. So administration fee is also sometimes called retention. It's a fee, and it's always on a per employee per month basis to adjudicate your claims. They also do the billing, eligibility, customer service, network access, etc. Now, sometimes this would be a traditional carrier, like Highmark will do self-funded, and they will be your admin, your TPA. United, Cigna, UPMC, they'll all do that. But there's also another option where you can not go with a carrier themselves and go with a true third-party administrator that's independent of those insurance carriers. And there are many of those around as well. Sometimes that's a lot less expensive from an admin point of view. Some of the carriers, you might see a $60 PEPM for doing admin, whereas if you would go to an independent third-party administrator, it might be around $20 to $25. So it's something that your consultant, i.e. us, would be looking at, and we would be making recommendations. But you also have to be careful with those third-party administrators that are independent, that they can actually do the job on a consistent basis. So I just talked about third-party administrators. That's the entity that administers a self-funded plan for an employer, so on their behalf. And then you have expected claims, and expected claims is simply what an actuary thinks going to happen in your company for the upcoming year. So that's the total claims that an underwriter expects, or an actuary, that a group would have in a policy year, depending on their experience. And if you're new to self-funded, really the only way there's 2 ways they can get and do this predictive modeling, as it's called. They can ask for medical questionnaires, and each one of your employees would fill out a medical questionnaires. That can be a bit onerous, but it's the wave of the future, and it's actually the wave of the past, too. If you remember, if any of you online were small groups, small businesses some time ago, it was very, very normal if you wanted to go to UPMC or Aetna or Health America at the time to fill out medical questionnaires for every single person, because that's how you get an idea of the true risk of a group. There is another way that's beginning to pop up. Aetna in particular uses this, and some third-party administrators that are independent use this. They'll gather your census information. Sometimes they'll ask for a social number, and then what they'll do is they'll bounce that information up against national databases, particularly drug databases, and then they'll do predictive modeling based on what they get back as far as prescription drugs. They can do predictive, they can basically tell what's wrong with somebody based on the drugs or prescriptions they might be on. So it's an interesting method, and it's less intrusive. There usually is an extra risk charge added to that because they're not getting the medical questionnaires, but in fact, it is sometimes an easier way to do things on the self-funded side. For less than 100 employees, claims history isn't available, so you do have to do the census. We have to look at prior renewals. We have to look at MQs, that kind of thing. Just to expand upon the medical questionnaires, a lot of times if you are above 100 employees and you have some history, then that means you would have had claims history, and you probably will not have to fill out medical questionnaires if you're above 100 employees, unless you've never had insurance before. And there are some clients out there like that. So just as an FYI. Okay, so one of the big things that a lot of employers are worried about when they go self-funded is some kind of catastrophic large risk that's out there. And one of the biggest you'll ever see is a premature baby that has to stay in a hospital for a long period of time. That could easily be over $1 million claim, okay, on a single person. So the reason the reason that employers get a little leery about this is, like, how are we going to pay for that if we are in fact self-funded? We're paying these claims. Am I responsible for $1 million claim? The answer is no. You would buy something called stop-loss insurance, and that's included in a self-funded package. And you would be paying for that. It's this premium, just like any other insurance, but you're paying so that if claims go beyond a certain amount on a single individual or on an aggregate basis for your entire group, then the reinsurance kicks in and you are protected. And that's how we cap your risk in a self-funded plan. So when I'm talking to employers and they're worried about extra risk that's centered around self-funded, there are some instances in the past where people probably have purchased self-funded insurance or became self-funded and didn't purchase the reinsurance. And therefore, that's what's called a naked upside, and you are just exposed for any kind of catastrophic claim. If self-funded is structured correctly, there is no extra risk to it compared to fully insured. Okay, so I just want to put that out there. You can read through the screen, but basically it says what I just said. We are capping the risk with a reinsurance program, but it's all based on what your expected claims are. And an actuary, again, will predict that, and then they can get a basis and a baseline from which to start. Okay, so stop loss. Let's talk more about that reinsurance. As I just said, there's what's called a specific. Sometimes you'll hear it called a spec. It's the stop loss on an employer against large claims, but it's for a specific person. And every employee has that, and not only employee, but the member as well. It goes down to the member level. So anybody that's insured, more or less. By the way, if you're above 100 employees, and you get to see some of the renewals that come from insurers, you will always see something called a pooling point. That's a dead giveaway, and it shows you that in fully insured carriers also have reinsurance on their own policies. So from their perspective, if you're fully insured, they are the self-insurance entity, and therefore they also protect themselves. So pooling, if you ever hear the term pooling point, specs, if you hear the word aggregate means, if you step down there, aggregate stop loss. So that's sleep insurance, and we call it sleep insurance for the CFO, which is basically saying, hey, if everything in the world went wrong, what would happen to us? And because you have aggregate stop loss, you would get against having those doomsday scenarios. And typically we would set that between 105 and 125% of expected claims. And it's usually, for groups that are smaller, it's usually set around 115 to 125. If you're at 105, it's going to cost you too much because basically you're not giving yourself any, you're not taking on any extra risk at all. Okay. All right. Now, another important thing that you have to look at for a stop-loss policy, and if your consultant knows what they're doing, they will know this. Specific stop-loss come in different contracts. They are going to be either a 12-12, a 12-15, sometimes a 12-24, sometimes a 12-18. What that means is you're covered for 12 months on the stop-loss, and then the second number means what am I covered for the run-out? Because if you know anything about how claims process, they're never actually processed on the day they occur. They're paid later. And so let's say your policy ends on 12, goes from 1/1 to 12/31. Well, there's claims coming in after 12/31, obviously. So you want to be protected. The only people that usually have 12/12 are folks that are self-insurance assured and they are bigger. They're not really worried about run-out because they're just going to renew in their self-insured plan for forever. If you're in a smaller group, you may very well be looking at moving from self-insured, and at some point, you want to have the option to go back to fully insured. If you have a 12/12, you're not really going to have that option because you're going to be exposed for any kind of run-out claims. So you definitely want to check that out. You want to be in 12-15, a 12-18, sometimes a 12-24, to have a little more wiggle room to return to fully insured, or God forbid, not have to pay. You definitely don't want to have to pay run-out claims because you just don't know what you're going to run into. So it's all about protecting your risk. So some of the advantages of self-funded, and a lot of people ask me, why would I want to do it? Well, the number one thing I think that people need to look at is it gives you control. You know your numbers. You have the right to see your claims, and you will see your claims on a monthly basis. And therefore, by the time, 4 months before your renewal, you pretty much know how you've been running, and you know what your stop loss might go up, it might stay the same, and you might be quote-unquote in the money, as they say, or you're making out or you're not making out. So at least you know the facts. You also can have some interest income. So, and by that, what do I mean? Well, you've never paid the claims that you didn't have. So in a fully insured arrangement, you are paying for claims that may never happen. If you can retain some of that cash, obviously you can get some interest income from that. You definitely have improved cash flow, meaning you don't have to pre-fund anything that didn't occur. Okay, you definitely have less regulation. That's particularly on the state side, and you could save anywhere between 2 to 6% off the premium, every premium dollar, just because you moved to self-funded. And then there's other cost savings. Where you can, obviously you may have not spent for the claims that didn't happen, and therefore you just have some money left over. So there's savings there as well. Okay. Now, self-funded plans are becoming more and more important, particularly, and it is going down to the level of 10 employees. Now, I oftentimes don't recommend self-funded for anybody lower than 25 or 20 employees. Only because you tend to flip-flop too much and back to fully insured, and there is some risk in that. Meaning, if you were self-insured and you had a good rate, but everything blew up, you'd have to go back to maybe fully insured because the self-insured companies don't have to insure you. They could say, well, we're done. You have to go back to fully insured. At that point, you may be looking at an increase that was unexpected going back to fully insured. So that's what I'm talking about risk. It's not actual claims risk. But it's becoming more and more popular. It used to be that you had to be at least 300 people for employees to even look at self-insurance. Now we're going down to a much lower level. The reason is that, particularly in small group, if you're below 50 and above 20, you may want to start looking at self-funded because eventually all the grandmothering prices are going to wear off or go away in theory, and you will be forced to move into an ACA-rated model. It's the Affordable Care Act, and you may be looking at a very, very substantial increase. At that point, you definitely want to look at self-insured. And then the mid-market accounts are definitely looking, and by mid-market I mean above 50, below 300. They're all looking at self-insured, and basically to get that control, get that information that they're not getting today. Okay, so you can see it's increasing. Now, for smaller employers, less than 100, healthcare reform, as I said, is kind of forcing people to look at it. Regarding your specific stop-loss pulling point, smaller employers need to be like a $10,000 or a $25,000 mark. And if you don't understand that, that's okay. That's something we would discuss with you as an option. But smaller employers do not have the risk appetite, obviously, and the cash flow to really kind of wing it. So you have to be a little more structured, a little more rigid in these arrangements. And smaller employers I would put a smaller employer to start with in something called a level funded program. And really what that does is it maxes out all your potential costs, and it creates a tiered rate just like you're used to seeing today on a fully insured side. So you pay those rates, and it's kind of like a refund program. If you pay all those rates all year and you have better than expected claims, then that money that you didn't spend comes back to you. Now, not every carrier will give you all the money. It may be 50%, it may be 2/3, it may be 100%, depending on who you use as a TPA. And again, that has to be something that we talk about. But in those cases, you can get a refund back. Now, that refund you can't just spend on a new truck. Those are plan assets, and those have to be used for health plan expenses. So a lot of people, what they'll do is just reinvest that in the premiums the next year. Okay, so I just went through the level funded alternative. Nothing else to talk about there, but that is the way to go if you're a smaller employer, and definitely if you're below 100, I always recommend a level funded program. Now, why JRG? Obviously, we have a ton of experience in mid-market and smaller groups, and that's kind of our forte. And we have the best programs out, some of the best programs out there for self-insured, level-funded programs. One of the great things that we offer today is that if you, as a smaller employer, meaning under 100, want to look at your actual risk, we will ask you to say, okay, we can go through this. We'll ask you to do electronic MQs. So the days of paper medical questionnaires are going away. We would share a website with you or a link, and you can blow out the medical questionnaire to all your employees electronically. They answer them at work or at home, whatever you want. Those questionnaires come back, and we can quickly give you a risk analysis of what your group looks like. And then we can say to you, yes, it looks good for self-insurance, or no, you're good on fully insured right now, but at least you know. And you do get a 4-page utilization report, which really allows you to see in your group for the first time. There's no other way that you can actually get that kind of information. So if you're interested in that, by all means, contact JRG. We will get you into the risk assessment program. The beautiful thing about it, if you are qualified for self-funded, you can also use that same electronic platform to do all your enrollment. It's loaded into the system. Everybody gets to go online and pick their product, so it's an online exchange experience. And that's just a really nice way to go if, in fact, you're qualified for that option. The big thing is at the bottom there, you'll see in bold, at renewal time, there are no surprises. You knew how you were doing all year long, and nothing can really change that, but at least you know, and it's very important. Okay, so at this point, I'll open it up for questions. Janet, is anything being typed in right now?
Yes, there is.
Okay.
One moment, please. The first question, who is responsible to pay a service provider for any excess after a stop loss?
So I think the question is, if you hit the stop loss, you know, is there excess beyond a certain point where you would have to be responsible for that? And the answer is no. It's unlimited. So there's no limit to your spec coverage. So once somebody hits that, that's on the stop loss carrier. You no longer have to worry about it whatsoever. Any other questions, Shannon?
No questions at this time.
Okay. All right, folks, I want to thank you for attending today's webinar on self-funded. If you have not yet explored the self-funded option, I very much encourage you to do so. Give us a call, and we will be talking about this more and more. It'll become common knowledge, and I think all your colleagues out there in the business world will probably be talking about this sooner than later. If you have any questions about that, please give, as I said, give JRG a call. We'd be happy to walk you through any of those options, and I hope you have a good day. For more information, you can call our 1-800 number. You can always email us at info@jrgadvisors.net. And, of course, there's always information on our jrgadvisors.net website. So we welcome you to check out all those resources. Thank you very much for your time, and have a great day, folks.